Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. So Prologis is not a REIT that investors necessarily think about when they're looking to capture the best yield. But this industrial real estate investment trust, big in logistics, warehousing, light manufacturing, a real global player, certainly enters into the conversation when you start talking about dividend growth. I'm Jason Hall. This is The Smattering. Tyler Crow here is with me to talk about the secret behind Prologis' stunning dividend growth over the past number of years. Hey, Tyler.
How are you doing? I know you get so excited to talk about industrial real estate. That's why you bring me in, though, to talk about things where you kind of shake your heads.
Sometimes it feels sleepy, but at the same time, the reason it doesn't pay a high yield is because the market values it highly because of what they're able to do. But a lot of investors don't understand why that's the case, and they skip right over it because they don't peel the layers back and understand it. So I'm gonna kick it over to you here to talk about Prologis, a little bit about the business, but let's really focus on this reason why they've been able to grow that dividend, and they're probably going to be able to continue doing it. They're probably going to be able to continue to grow the dividend going forward, even as the cost of capital environment has become far more challenging for a lot of companies.
Sure. So, there's two things we can talk about here. We can talk about what's going on right now, which has made it do so well. And that's industrial real estate has been one of the best commercial real estate sectors in the market right now. Rents for industrial real estate have been growing at rates we're just not accustomed to seeing. Now let's back it up a little bit further. There's another, if we're talking about why this company has been able to generate a return that is almost triple the S&P 500 on a total return basis since it IPO'd, is because, number one, management has been good stewards of shareholder capital. I mean, that's probably one of the most important things whenever you come to an asset-heavy business. And it has a low cost of capital. It doesn't have operations just in the United States. It has operations in Europe, elsewhere, and it has access to cheap capital both here and abroad. The last couple of issuance of debt that it has done, it has been able to borrow money at less than the rate that the U.S. government can.
That's remarkable. I want to just spend a second, Tyler, and talk about why that's important for a business like Prologis or some of these other REITs. And the reality is, when you buy real estate, and it's not that different if you're a business than it is if you're a homeowner and you're buying your house. These are very expensive assets, but they're also very long-lived assets, right? So it's the kind of thing where you can take on debt and that leverage can help you afford to acquire it, number one. And there's low risk for the lender because, again, that asset is very likely to maintain or increase its value over time. So it's the sort of responsible use of debt for businesses. And because Prologis focuses on real estate, access to capital, particularly via debt, is incredibly important for its ability not just to maintain its existing assets, but also for its ability to be able to continue to grow its business.
Yeah, absolutely. I mean, just think about it this way. If I am Prologis and I can develop or purchase property with my cost of debt being below 3%, for just giving a hypothetical example here, versus my competitors who have to, when they want to make the same development or acquisition, has debt interest rates in 5 to 6%. It means that I can pencil more deals. I can either get higher rates of return than they can, or I can undercut them and still grow.
The difference between 3 and 6% and 5 or 6%, you might think, well, that's only a few percent. But if you actually extrapolate the giant numbers behind it in terms of the size of the debt and the cost on the operating statement versus the cash flows, again, that's the difference between its competitors and the 30% rate spreads that it's able to get. It's substantially more profitable on a cash flows basis.
Exactly. So, all of that said, Prologis right now has a dividend yield of 2.8%. It's really not great in this environment, right? If I can get a treasury for a considerably higher yield, that doesn't compare well. But just for example, over the past year, at its last time it grew its dividend, it grew it by 25%. and based on the its uh, funds from operations per share that it has grown over this past year, a 20% or greater dividend increase in the next coming increase would not be shocking either. So when you're getting those kinds of dividend increases, then something like a lower yield doesn't seem as unattractive.